Hey everyone. One of the things I've repeatedly said over the last 6 months is that a recession is highly unlikely without a substantial rise in the unemployment rate. Unemployment has been hovering near the 50-year low rate of 3.5% for the last year or so. Virtually every recession in modern history has been preceded by a 50 basis point rise in the unemployment rate. And as I've suggested in the past, it'll be difficult for the unemployment rate to rise above 4% as long as we have a significant labor shortage. Last year, the number of job openings in the US averaged over 11 million each month. At the same time, an average of just 6 million people were looking for work at any given time. Throughout the last year, the labor shortfall has hovered in the 5 million person range. But it looks like some cracks are beginning to form in the labor market. Last week, the February Job Openings and Labor Turnover Survey Report, better known as the JOLTS report, came out. And for the first time since May 2021, when we were still recovering from the health crisis, the total number of job openings fell under 10 million. The number of job openings shrunk by about 670,000 positions in January, and that was followed by another 630,000 decrease in February. That's a 1.3 million swing in the number of job openings in just 2 months. Looking at the trend over the last year, the professional and business services sector and the information technology sector softened most. That makes sense because these types of jobs didn't downsize much during the pandemic. And it's been the small to mid-sized companies that have been most impacted. The number of openings posted by companies with between 250 and 1,000 employees is down by 39% compared to last year, while the 50 to 250 employee segment and the 1,000 to 5,000 employee segment are both down by about 22%. Small companies, those with fewer than 50 employees, have reduced their job openings by 2.5%, while the number of job openings at big companies with more than 5,000 employees is actually up by 1.5%. So we're seeing the greatest momentum shift in white-collar jobs at mid-sized firms. Now here's why the shrinkage of job openings is important. For the last 6 months or so, the Fed has emphasized the need to bring down wage inflation. Basically, wage growth has been running in the 4.5% to 5% range, almost double the pre-pandemic long-run average of around 2.5%. And wage inflation flows into most other areas of the economy, from manufacturing to distribution to construction to hospitality. When wages are rising particularly fast, those labor costs roll into almost every other facet of the economy, compounding inflationary pressure. That's why Chairman Powell mentions the need to raise the unemployment rate to the mid-4% range in almost every press conference. But like I said earlier, before the unemployment rate can go up, we need to burn off a big portion of the job openings. And we may now be seeing the first step in that process. The question is, will shrinkage of the labor shortage be enough for the Fed? Will the cracks we're starting to see in the labor market be sufficient for the Fed to hold off on their rate increases? The answer to that question may be a game-time decision. The Federal Reserve's next meeting will be on May 2nd and 3rd, and the next JOLTS data release will come out on May 2nd. Following the release of the JOLTS report last week, Wall Street was pricing in a coin toss on whether the Federal Reserve leaves rates alone in May or if they'll raise the overnight rate by 25 basis points. And that decision will have a significant bearing on the economy, the employment market, and on commercial real estate lending. If the Fed raises the rates by 25 basis points on May 3rd, then the probability of a recession may push higher. In addition, commercial real estate lending will likely be further restrained, and that could weigh on commercial real estate transaction activity. Conversely, if the Fed keeps rates flat, then lenders may be able to stabilize their offerings, which would support the commercial real estate price discovery process and begin the revival of transaction activity. Many investors are still on the sidelines. They're waiting for additional clarity and waiting for additional stability. But some investors are active, mostly private capital investors. They're active because they're looking for high-quality assets that will stand the test of time. They're focusing their strategy on a longer outlook because they're keeping their eyes on the horizon.